Okay. All right, so my presentation is going to cater to everybody because I think it's important when we're talking about the emerging technologies and the impact it has on us all, that we all have a level of understanding. So I'm going to go through my first presentation and then I will open it up to questions. Just as a point of trivia, today is Satoshi Nakamoto's birthday. So that's the person or the people that built Bitcoin. As a bit of a trivial piece of information for today. So just to introduce myself, I've been working with the Commission, obviously, on helping them help with the license requirement. I'm an ex-banker myself. I've run a number of banks globally. I was a derivatives trader for 30 years. I started my life as a futures trader on a trading floor when we didn't have computers or mobile telephones. So I come from a very financial markets background. I got into blockchain in 2012, long before it was cool. I bought my first Bitcoin at $40, which seems a long lifetime ago, and I wish I had bought more and I hadn't have lost most of it. So in about 2013, a very good friend of mine, a man called Greg Metcalfe, he was the head of the Australian regulator. And he said to me, you need to go and have a look at this thing called blockchain because it's going to change the world. We have daughters the same age, and I thought he was talking about Minecraft. So I spent a weekend on this game called Minecraft wondering how the hell it was going to change the world. But when I said to him on the Monday, I don't know what you're talking about, and we started to discuss blockchain, we're on the right track. So I helped set up the Australian Digital Chamber of Commerce in 2014. Which was an industry body around for digital assets. And so my work started working with the government, and I started to look at the Australian laws because I'm Australian. And I figured out that the Corporations Act and some of the laws that we were referring to weren't technology agnostic. So I lobbied very hard with the government, and I had some things changed. I looked at blockchain not from the perspective of cryptocurrencies, because I was a derivatives trader. I looked at how it could help me in things like clearing and settlement. You all probably know with FX markets, with securities markets, with bonds, debentures, the clearing and settlement times can be trading can be instantaneous, but clearing and settlement can take 3 days if you trade a stock. It can take 27 days if you trade a water entitlement. Don't ask me why. So I looked at using the technology to remove clearing and settlement risk. So that was how I got into it, not through Bitcoin. I then tried to buy some more Bitcoin, and it was a very convoluted process. So I figured out pretty quickly, a lot of the people in the industries, they didn't really understand much.
Just one second, Loretta, just 1 second. Can you check if you can increase the volume from your end? Because we have unfortunately, it's the sound is low a bit.
Oh, I'm on maximum.
Okay, we'll bring the screen a bit closer. Maybe it's gonna be like more family. I've tried everything.
I'm in lockdown in Australia, and we're not allowed. I'm not allowed to be 1.5 meters close to anybody, so I feel like I'm being a real person. Yeah, so I started my journey in 2014. I then looked at what people were talking about. Were people talking about cryptocurrencies? Were they talking about virtual currencies? Were they talking about digital assets? And I figured out pretty quickly that everybody was talking about exactly the same thing, but calling it something else. So I worked very hard with the Australian government, and we came up with the definition of a digital asset, which I'll go through. So a digital asset is a new asset class, effectively. It's just, we've all traded assets. FX is an asset, securities are an asset, commodities, bonds. This is just another asset class, but it's derived in a digital world. So that's the broader basket, a digital asset, of which then you have things like virtual assets and cryptocurrencies, which are just subsets. So anything that is native to the digital world is now a digital asset. And we can digitalize any asset class that exists. So we can now digitalize a kilowatt hour of energy. We can digitalize money, which is what Bitcoin is. We can digitalize a commodity. We can digitalize a gold bar. So we can now digitalize all these assets that exist, and even ones that don't exist yet, in digital form. So I've helped a number of countries write legislative programs now around digital assets and cryptocurrencies. So I've worked in Bermuda, I've worked in Mauritius, I've worked in Serbia, Antigua, Jamaica, Australia, Canada. I'm one of the advisors at a cryptocurrency exchange called Binance. I don't know if anybody's heard of Binance. So I help them on their regulatory platform, because they're in a bit of trouble with many regulators, because they're the biggest exchange in the world, and nobody knows how to box them. I work with the OECD, so I've been an advisor on blockchain to the OECD since 2017. I work on a number of policy papers and a number of advisory boards with the FATF, which is the money laundering terrorism financing standard body. And I also work with the OSCE, which is sort of like the NATO of the OECD. So I've got plenty of experience working with different jurisdictions around the world. As I said, I come from industry. I learned to code when I was 43, so I coded across 3 different blockchain protocols. And for me, it's been a big learning curve. I think I'm probably the oldest person in cryptocurrency. So we have to go back, if anybody knows much about Bitcoin. So Bitcoin was the first application of this new technology called blockchain. Now, it came around in 2008. Somebody called Satoshi Nakamoto. We don't know if that was one person, that was a group of people. We don't know who Satoshi is. Put out what we call a white paper. So effectively a business plan onto the internet in 2008, just after the GFC hit, which talked about a peer-to-peer cashless payment system. Now, why is that so important, and the date so important? Because the GFC had just hit, and people had started to lose trust in their governments. People were questioning whether banks should be the best custodians of money in the world, and there was a lot of upheaval, a lot of angst, and the financial system started to get questioned. So a lot of people looked at this white paper by Satoshi as an alternative. As a new alternative to the financial system. It was also the birth of Bitcoin, and Bitcoin, as I said, was the first application of this new technology called blockchain. So what is blockchain? Blockchain is just a fancy word for a database. And that's really all it is. I mean, I try and explain things simply to people, because I'm not a crazy technologist, and a lot of the time the technologists that build these emerging techs don't know how to describe things in layman terms. So blockchain, it's a fancy word for a database. But the difference with this database, and you all use databases every day, but the databases you'd be using are what we call centralized. They're controlled by a centralized party. They sit in a centralized server. Bitcoin is what we call decentralized. So this database is what we call immutable. It means it cannot be changed. It's transparent and it's secure. So people are going to tell you a lot about Bitcoin and cryptocurrencies, but I'm going to tell you one thing about blockchain which makes it so unique. Blockchain and this database that created Bitcoin being the first is the most secure database that we've ever seen in history. Now, it has never been hacked. Every other database we use, every government's database, every big company's database has been hacked. And the reason it hasn't been hacked is because it's decentralized. So nobody controls this database. Everybody, if we're all in the Bitcoin network now, we're all using a computer and we're effectively looking at the same spreadsheet. So we can see every transaction that moves on that spreadsheet, but we can't change it, we can't alter it, and we can't hack it because it's not sitting in one central database. Everybody that's part of the network owns the network or participates in the network. So that's what makes it very different. So blockchain itself is a combination of a number of technologies. It's a combination of cryptography, which is encryption of messages. Encryption has been around since the Second World War. So that was when the Allies could send messages to each other in a secure manner, so it couldn't be intercepted by the Germans. So that's cryptography. So that's encryption of messages, which is a way of securely sending information. And then the internet came along, and the internet was built by a man called Bob Kahn. Bob Kahn has become my mentor in all of this stuff because I didn't understand how the internet was built. I was a banker, so I had to rely on the information of people that build technology. He seemed to be the best person to ask, and although he thought I was a bit strange when I first went to him, he's become a very dear friend and he's taught me a lot about the internet. So what was the internet? The internet, he sent a message across an open network to a man called Vince Cerf, and that message said hello. But it was the first time in history that an open network could send value openly. So the internet allows us to send value across an open network. We all send stuff on the internet, but what's the problem with the internet? It's not secure. And Bob, when he built the internet, because all these technologies come out of US defense generally. So when the internet was built, he was told specifically not to put in a security layer. So the internet was the first time in history we can now move value across open networks. We can send messages, information to anyone, anywhere in the world. But the problem we have is not secure. So along comes blockchain, along comes the application of Bitcoin, 2008. The Bitcoin protocol solved that very problem of security. So now we can move value and information across an open network that is secure. And that's the fundamental thing I think about blockchain technology, which nobody realizes or it's not discussed enough. So, you all use this device, the mobile phone. Everybody's got a mobile?
Yes.
Your children? Yeah. How hard is it to get your phone out of the hand of your children? It's become like a third limb of my daughter. But we use that every day. Now, you don't know that on top of the phone that you use, there's 78 protocols built on top of what Bob Kahn built. So he built the IP, the Internet Protocol, and what we call the Transmission Control Protocol, the TCP. So in form of the internet that you all use today, that has 78 protocols that have got embedded security built in. So if you just got to think of the blockchain like an infrastructure, it's just now a security protocol layer, which has been embedded into the internet. So that's what makes it so revolutionary from a technology perspective. That's why everybody is really interested in blockchain. And Bitcoin was the first application of this technology. So that's why Bitcoin is obviously the biggest protocol around. It's been around the longest, and it was effectively the digitalization of money. Now, you have to be careful when we talk about money, because money means very different things to different people. Money can be, if you look at how money was created, back thousands of years ago, we used to transact value by swapping shells, or I would swap potatoes for corn. It's a barter system. Now, over time, that got difficult. People moved to shells. Then some of them moved to gold rocks, some of them moved to other forms of payments. And then eventually, about 300 years ago, that moved to fiat currency. So fiat currency is now paper, which has got the head of somebody that runs that country's head stamped on it. So that's what we refer to as fiat currency. But fiat currency has evolved out of money, but money is not fiat currency. So we have to be careful with definitions when we're talking about what money is. Now, Bitcoin itself, if you look at it, is inherently a store of value. It's very slow, it's very clunky. It takes 10 minutes for a transaction to be completed, and that's because it was built for its security. It wasn't meant to be a payment system. So it's not fast. There are some other cryptocurrencies which are built to be payment systems, but none of them fulfill the definitions of what we call fiat money. The fiat money needs to be a store of value, a unit of transfer, and a unit system of payments. So if you look what central banks control, they control fiat currency. Bitcoin is not a coin, and we'll get into that in a bit. Cryptocurrencies are not currency. In the laws that I write, I say this is not legal tender because cryptocurrencies have more the characteristics of commodities. They're not currency. And I really wish, had the Bitcoin guys, you know, a bunch of technologists who didn't understand much about laws and regulations, had have called Bitcoin Zen token, nobody would have cared. But the minute you put coin into things, you put currencies, you really start to confuse terms, and terms that we use as policymakers and regulators across all manners of things. So Bitcoin and other cryptocurrencies are more like commodities. They are not, they do not in any way fulfill the role of fiat currency. So it's a bit, I don't know if anybody's read about El Salvador in the last few days making Bitcoin legal tender. Very silly thing to do, because we'll get into that, because, you know, it's a commodity. It's like having the gold standard reinvented, but gold is not volatile. If you look at cryptocurrencies, they are very volatile. They're very speculative. They're not backed by anything with intrinsic value. So we're getting into unexplored territories. You know, if the price of Bitcoin, you've seen it gone up for a long time, and we'll get into how speculative it is as an asset, but it can also come down. So I always say to people, be very careful when you look at cryptocurrencies, because you need to be prepared to lose every cent you put in. You know, the markets are very volatile. They can go up and they can come down very, very quickly. So you really need to understand your risk, and you need to understand what drives these markets. So as I said, blockchain, it's just a big ledger, except it's decentralized. If we opt into the system to use that ledger, we have to agree, all of us, to play by the rules. So that's what we call the governance mechanism. So if anybody wants to change the rules of the Bitcoin protocol, we all, or 80% of us in this room, have to agree to change it. So just because you're big, you have big stakes in things, doesn't mean that you can change things in the Bitcoin world just because you want to. So it's very, I guess, democratized in a way. So it's called blockchain because it's effectively a whole lot of information. A block can have such data as name, date, timestamp a transaction was done, and every time that more information is added to the ledger, the blockchain, more information is put on, one block joins another. So you can never take any of that information out. You can never change it. You can just add on to it. So that's why we call it a blockchain, because it's effectively a chain of blocks chained together. Now, there are many use cases for blockchain, and I think Bitcoin was obviously the first, the digitalization of money, and that happened in 2008. So since then, we've seen lots of innovation in the technology. Everybody's coming up with use cases for this immutable, transparent database. Things like land records is a very good use case, because if you think about it in history, land titles are kept, you know, in vaults. They're pieces of paper. They can get burnt, they can get destroyed. When nefarious governments take over countries, the first thing they do is take land. So if we could start to have registers, like registry functions of assets that are owned and not put in paper form, we can start to open up other asset classes. So if you don't have title over your land, and it happens a lot in the emerging world, you know, you can't buy any more land. You can't prove that you own that land to get credit. You can't get, you know, bank loans. So there's a lot of things that make land titles important. Another very good use case, and many people are using it, working on it at the moment, is digital ID. So digital ID is probably one of the best use cases I see, because a lot of people in the emerging world, look at Africa, India, people don't have an identification. So the passport's a very old way of being identified. The signature is so antiquated. But if you don't have an ID, you can't do anything. So if nobody knows who you are, and you're not registered as being a person, you can't vote, you can't buy land, you can't get a bank account. There's so many things you can't do. So as time and innovation goes on, blockchain technology is moving out of the first use case of, say, Bitcoin and other cryptocurrencies, and people are coming up, with really interesting use cases. So Bitcoin was created in 2008. Has anybody heard of Ethereum?
Yes.
So Ethereum is another blockchain. Bitcoin is its own blockchain. Ethereum came along in 2012. Now there's a guy called Vitalik Buterin, who at the time was 18. He's a half Russian American coder who said, well, if we can now digitalize money, and Bitcoin is the digitalization of money, why can't we digitalize other asset classes and other assets? So he came up with the concept of Ethereum. Now, Ethereum is just another blockchain. It runs on a different protocol. The interesting thing about Ethereum is it came up with the notion of smart contracts. Now, smart contracts are not smart and they're not contracts. It's just executing code. So it says, all right, if I could on a registry transfer a land title from me to the commissioner, there's a set of contractual rules that allow me to sell my house or to sell my land to the commissioner, and that happens in code. So at this point in time, everything we do in contractual law, contracts, it takes a lot of time, a lot of money. You need lawyers, you need accountants. There's a lot of middlemen involved in transactions. So smart contracting is effectively shrinking all those functions that we need for intermediaries into code. So that's probably the game changer that Ethereum built, this smart contracting function. And there's been a few more other blockchains that have come into existence, other cryptocurrencies since Ethereum. But Bitcoin and Ethereum are the big ones. There's something called decentralized finance, which is now effectively peer-to-peer financial transactions that everybody in the world can do. That's built on the Ethereum protocol. You'll probably get questions from your clients about DeFi and DeFi projects. So that's why I'm bringing that up. So blockchain inherently, good for cryptocurrencies, for creating them, but it's also good for record keeping. As I said, now we can put registry functions like land titling, digital ID on the blockchain. The other interesting thing is that Bitcoin is atomically swapped, and it takes blockchain technology allows us to swap assets digitally without the need for an intermediary. So we used to, things like remittances. Remittances are a big pain point around the world, cross-border payments. If you're sitting in the Philippines or you're sitting in Canada and you're sending money home to the Philippines, that's costing you a lot of money with people like Western Union and all these money service businesses. So if you're sending, I think I figured out remittance payments or remittance costs to do remittances cost between 12% and 18% in the world. So if you're moving $50,000 or $100,000 and you've got to pay a fee to do that, it's probably not going to hit you too much. But if you're like a poor migrant worker in Canada and you're returning money to your family in the Philippines, you're sending $200 a month home, it can cost you up to $80 to send that $200. That's a huge hit of your bottom line. So so we're seeing big innovation in things like remittances using cryptocurrencies. So that's disintermediating traditional financial services. So there's use cases that have been discovered and as the technology gets older. So a lot of people say to me, we need a blockchain. And sometimes yes, and sometimes no. So blockchain technology, it's a big ledger. But if you're transacting with somebody that you trust, if you've got a transaction record, you're sending something to somebody that you trust 100%, and it's just two parties in a transaction, you don't need a blockchain. If there's three and you trust the parties that you're interacting with, you probably don't need a blockchain. But blockchain works specifically when you have multiple parties in a network that need to exchange information, but they don't trust each other. That's really the only time that's a good use case for blockchain. A lot of people say, we need to send this data from one database to another. What you probably need is just a better encrypted database. There's nothing wrong with using an encrypted database. In fact, many occasions, it's better to use an encrypted database than it is a blockchain database, because blockchain is also very energy inefficient. You've probably all heard there's a lot of talk about the moment that it takes so much energy for these transactions to go through all these computers around the world that it's costing a lot of energy. It's not green, although they're moving to much greener ways to use the technology. But the problem has been up until now that it's very electricity inefficient. So another interesting point in when you're dealing with cryptocurrencies, that you'll probably heard a lot about coins. We hear about Bitcoin, but we also hear a lot about tokens. They're not one and the same thing. So a coin, like a Bitcoin, or there's some called Litecoin, there's other cryptocurrencies that refer to coins. So generally they use the Bitcoin protocol, but they're forks of it. So they're alternatives to Bitcoin. So anything that says coin in it is a derivation of the Bitcoin protocol, or it's an alternative to Bitcoin. So usually what happens is, because everything about Bitcoin is on the internet, it's what we call open source. Any coder, any programmer can go onto the internet, go in, look at the Bitcoin protocol, use it or change it. So if they change it to create another cryptocurrency, it's what we call, they fork it. It's a fork in the Bitcoin protocol. It's a variant. It's just another coin built on top of Bitcoin. Altcoins exist on other blockchains that don't use the Bitcoin blockchain. So things like I mentioned Ethereum. There's another cryptocurrency called Ripple. There's a number of cryptocurrencies that don't have anything to do with the Bitcoin protocol. They solely rely on their own blockchains. So Ripple and Ethereum are very good examples of that. So I think also a token is different to a coin, because a token is just a representation of a particular asset or utility, and that resides on top of a blockchain. So as I said, Ethereum came out, and it does more than Bitcoin does in what the protocol does. It can digitalize other assets. So many different cryptocurrencies, many different blockchains are using Ethereum, but they're building on top of the network, and they're creating their own tokens. So that's what a token is. It's just a representation of a utility or some sort of other asset, but it's usually built on top of the Ethereum blockchain at the moment. Sometimes there's another protocol that's come out since Ethereum. It's called Polkadot. Lots of these DeFi projects, a lot of other tokens are built on top of Polkadot. There's also Cardano. There's a number, and as we get more and more into the technology, these new protocols are being developed. So tokens can basically represent any assets that are fungible and tradable. So that can be from a commodity to an airline, loyalty point, or another cryptocurrency. So that's the difference between a token and a coin. Do I have any questions so far?
No.
I hope that's a good no. I mean, ask me any question, because it can get a bit, I mean, it's a very complicated thing. So don't expect, that you mean to know all this right off the bat. It takes many, many years of reading. So then, has anybody heard of an ICO, an initial coin offering? Okay, so initial coin offerings came up in about 2016 to 2017. So this ecosystem with blockchain and Ethereum had sort of developed, and most of the people in this ecosystem are young technology enthusiasts. So what they were building new businesses. Like Bitcoin was built as business, Ethereum was built, it created a company called Consensus. The problem was a lot of these young innovators and technologists were trying to build businesses and be entrepreneurs, but they couldn't raise any money. So, and some of them, as I said, Vitalik was 18 when he built Ethereum. A lot of these kids are very smart geniuses, but the problem was they couldn't get money. So there was only so much money they could get from their family and friends. Venture capitalists wouldn't give them any money. Banks wouldn't give them any money. So there was this big problem in the ecosystem of how do we raise money as our companies? Like, how do we build these new companies and these protocols? So Ethereum was the first to do it. They said, all right, well, if nobody's going to give us any money in the real world, what if we just go out to everybody in the world and do a digital crowd fund? So ICOs are just effectively digital crowd fund. They said, all right, we'll go and write paper. We'll go out and everybody can give us money in cryptocurrencies. So ICOs were mainly, they were capital raisers effectively, but they were done in either Bitcoin or Ethereum. Now that's all good and well. You know, people were going out raising millions and millions of dollars within a couple of months in cryptocurrencies. They were claiming that they were going to build, you know, the next Google 40. There was no regulation anywhere in the world. And usually if you're doing a crowd fund or an IPO, yeah, there's securities laws, securities regulation. So what has started, this movement of ICOs got very, very big. In 2017, I think 1.9 billion US dollars had been raised. Now, the problem was with all these projects, 97% of them were scams. So people were just going out saying, give me money, I'm going to build, you know, this fabulous protocol, getting the money and running away. So regulators around the world got really worried about this because consumer and investor protection became very poignant and people were getting ripped off. So I was in Bermuda in 2018. I wrote the first legislation around initial coin offerings. And what we did was we brought in regulation. So it was more to the point saying, buyer beware, you know, if you're going to get into these unregulated activities, make sure you understand the risk. So we put some particularly poignant restrictions on these ICOs. We said, all right, we need to know who the beneficial owners are, who are the people behind these companies. If they're raising money and they're just trying to raise it for investment, they're probably securities. So there was a lot of regulations that came in. That bubble sort of burst. People still use ICOs to raise money, but the scams and the fraudsters have all but disappeared. So that's one part of where regulation was good, because, you know, mums and dads and consumers all over the world were getting scammed. So that was not the good side of the industry. But it was interesting to see how the uptake of technology became very volatile, and how people were very happy to start to invest in projects that weren't in traditional finance or in traditional crowdfund, just equity raises. So that was why that was important. So crypto itself, how's it traded? It's traded on, they call themselves cryptocurrency exchanges. I don't like that, because I mean, I've built infrastructure at security exchanges over my career. Security exchanges are public-private partnerships. Security exchanges have very onerous rules by regulators, you know, the number of investors. There's a whole lot of rules around security exchanges. But again, like Bitcoin and Ethereum, the kids that started to build these cryptocurrency exchanges went, oh, that word exchange sounds like a good idea. We'll just borrow that. Now, security exchanges in traditional form, they perform something called novation. So when you go and trade on the Australian Stock Exchange or the NASDAQ or the New York Stock Exchange, the minute you do that trade, the exchange actually takes the risk of that transaction for a millisecond. So that's what we call the process of novation. There's big amounts of money that are put in case something goes wrong. With cryptocurrencies exchanges, all they are is matching engines. They match buyers and sellers. So I prefer to call them digital asset marketplaces, because in the true sense of the word as an exchange, they don't do any of the functions that a security exchange does. They're just matching engines. And again, they're a little bit naughty in how they borrowed terms from the traditional finance world. So they're usually held privately. The biggest ones in the world, as I talked to you about, Binance, there's Kraken, there's Coinbase. In Australia, there's Independent Reserve. You've probably all heard of some type of exchange. They trade for you cryptocurrencies on the exchange. You can also trade cryptocurrencies, what we call OTC, over the counter, just between different parties. But generally, people like to use exchanges because they quote they quote the cryptocurrencies in pairs, like Ethereum versus Bitcoin, or Bitcoin versus the US dollars. Now, they're very volatile. Cryptocurrencies are extremely volatile. They're very still unregulated at large around the world, and it's something that regulators have grappled with for the last number of years. It's easy to put fiat, as in fiat currency, hard currency, into an exchange. It's very hard to get it out. So yesterday I met with the banks. The biggest problem that we're seeing globally is that banks don't like people dealing in cryptocurrencies, or banks are de-risking. They think that dealing in cryptocurrencies, or companies that deal with cryptocurrencies, can be a money laundering, terrorist financing risk, or so they claim. So what we're finding around the world, more and more banks are deciding not to bank people in the space. So that you can have the best regulation and the best legislation in the world, but if your banks won't bank the companies, it's very problematic, because you can't buy your food or pay your rent in Bitcoin. So you need a banking rail. So the problem is, in the industry at the moment, it's easy to put money, fiat currency, into cryptocurrencies, but it's much harder to get it out. So as I said to you before, digital assets are a broader bucket. Like they're now a new asset class. Cryptocurrencies are just a subcategory. Some places call virtual assets. Have you all heard of virtual assets? Virtual currencies? It's all effectively the same. The problem is, and this is where regulation has been very difficult in the world. As I said, some jurisdictions are talking about digital assets, some are talking about virtual assets, some are talking about crypto assets. They're effectively talking about the same thing. But the big regulator that sits above the securities regulators, or the non-bank regulators, or even the bank regulator, the prudential regulators, is the FATF. And everybody has to conform to the FATF standards. So the Financial Action Task Force sets standards around money laundering and terrorism financing. And if you don't comply with that as a country, you'll get blacklisted. So that's very problematic. Vanuatu's had problems with the FATF. I mean, a lot of countries in the world have. Now, I really wish that the FATF in 2011, when they came up with the definition of a virtual asset, had have been aligned to other places that were talking about digital assets, because it makes it very confusing when you've got different regulators talking about the same thing but referring to it in a different name. So their terminology around a virtual asset is a cryptocurrency, effectively, that is built either on a decentralized database or a centralized. So that's the definition of a virtual asset. And you have to be mindful of this because you have to comply at a security regulator level, at a prudential regulator level, with the FATF guidance. So you really need to understand what a virtual asset is. As I said, unlike fiat currencies, paper with head stamped on it, a cryptocurrency is not legal tender. In all the laws that I write, I say it's not legal tender. Obviously, El Salvador have come out this week. They've said that. The Marshall Islands in 2018 came out with a decree that said that they were going to have a digital currency as legal tender. That put them in all sorts of problems. So I don't think that's a particularly good idea. We'll have to see how the El Salvador experiment goes. But it's a bit worrisome, because they could actually ruin the lives of people, especially now. The IMF have come out and the World Bank, and they're starting to debank El Salvador. So it's a bit problematic. So cryptocurrencies, they have value because you can exchange them for something else of value. As I said, it's more like a barter system. If the commissioner thinks that my bangle is worth his pen and we exchange that between each other, that's a fair barter. That's an exchange. So anyone can barter anything. If people think that a bottle of wine is valuable and they want to exchange that for a bar of gold, so be it. But I think that they show characteristics which are more akin to physical commodities than anything else. And if you trace back the first ever legal definition, or in a court of law, Bitcoin was deemed in a court in Nebraska as a commodity. So most regulators are taking the view now that these cryptocurrencies are more like commodities. So and a lot of places see, as I said to you, I mean, I hold Bitcoin and I've never sold any. To me, it's a store of value. And I think what you see, not so much with Ethereum and some of the other cryptocurrencies, but Bitcoin is more like digital gold. You know, people hold it because they think, you know, over time it's going to be valuable. So it's a bit like a real estate or a commodity. It's very inefficient to use your Bitcoin to do a transaction. It's very inefficient. It takes a lot of energy, and it wasn't built to be a payment system. So I think that's the key there. Digital assets in the laws that I've wrote, they exclude a transaction in which a business or is part of an affinity or rewards program. So take that more along the lines of, say, an Emirates awards point program. I can use my Emirates points in the Emirates networks to get an upgrade, you know, to business class on an economy ticket, or I might be able to get a bar fridge or some glasses, but I can't use those tokens, those Emirates reward points outside the network. So that's what I mean by that. And it's also not a digital representation of value that is issued within a gaming platform. A lot of gaming platforms use cryptocurrency to get people in and out, but it's actually can't be used with inside the gaming platform. So I mentioned a bit, so the challenges that we're seeing globally is mainly around regulation. It's around the different definitions of terms between different jurisdictions. What you're seeing is a lot of regulatory arbitrage. Companies are trying to go to jurisdictions that have got no regulation. That's causing problems because, you know, if you go and set up your business in Panama, I'll give you the big tip. It's much harder to move your business back into, say, Australia or Canada and the US. So I think there's been a lot of pushback on regulations too, because this industry really does it disintermediates things like financial institutions. So the banks have been very anti things like Bitcoin for a long time because they think they're going to be disintermediated. I mean, in reality, if you look back to when the internet was created, everybody said that, you know, when banks were going to not be in brick and mortar form, it was going to be the end of them. Banks didn't die because of the internet. They just changed their business models. So I think with any technology, technology can be used to enable things, and it's not a enabler. So I think, you know, over time the banks will become more interested in how they can actually use the technology to better themselves. Things like I said, clearing and settlement, yeah, they cost a lot of money. If you look at clearing and settlement, cross-border payments is very inefficient, very costly. Who's tried to move, you know, some money from Vanuatu to Australia or Vanuatu to Canada or, you know, the US? It can take 1 day, 2 days, 3 days. It can cost you like any sort of money. I mean, it's ridiculous. Yeah, it's ridiculous. So hopefully with this technology now we can start to solve some of those pain points. And I don't think, you know, things like banks are ever going to disappear. They just need to change their business models. Things like Uber, you know, Airbnb, yeah, they disintermediated their markets, but now everybody has to see the consumer, whether they're rich, poor, or in between, as very centric to their business models. And banks are no different. So we still have to be mindful of consumer, investor, and investor protection. I think the ICO boom scared everybody that were regulators, but I think now that's under control. I don't think regulators are in the business of regulating technology. I think that's really bad. And I always say to regulators, be careful what you wish for, because we can't regulate technology. We can regulate the services around that technology, but nor should we be regulating technology. And I think laws need to be technology agnostic, because technology is changing and innovating. If we're not careful and we over-regulate, we will kill innovation. And what you will see would happen with things like Bitcoin and Ethereum. They came from the dark edges. It'll just go back if we don't make this stuff mainstream and make it acceptable. I work in Nigeria for the Financial Intelligence Unit. A fun fact here. How many people do you think use Bitcoin in Nigeria? All right, I'll say 1 million. 10 million? 500,000?
I'll go first then.
50 million?
We've done that.
Okay, we have 110 million users of Bitcoin in Nigeria. And not all of them are using it for nefarious activities. You know, with the capital controls in Nigeria, it's very problematic. Entrepreneurs are using it to make money or to just transact in their day-to-day life. So people are not using, like 99% of this industry is not doing anything nefarious. But the social adoption, and because of the internet, the use of the mobile device, and especially in the emerging world, is going up so quite fast and so quickly, regulators can't keep up. And that's the problem. You know, regulators are at best 3 years behind. So my hat has to go off to the Vanuatu Financial Services Commission, because they've been great and they've been really receptive and understanding of this technology and wanting to learn. So I really wish that some of the big regulators would be as motivated to do this. So you've also got problems around the world, data privacy. The data privacy laws in Europe are very different to the US. That's very problematic for all of this stuff. Regulators. In the US, every state's got a different regulator. There's about 10 different regulators and everybody's arguing about who should be looking after, cryptocurrencies. Gary Gerstle, who's a friend of mine, but doesn't really understand technology, runs the SEC in the US. Now he's saying that everything should be a security, and things like Bitcoin are not, they're not securities. And then he's having a big argument with the commodities regulator, and then the Fed Reserve are saying other stuff. So they will never come to a cohesive decision in the US. Europe's the same. So what we're seeing is that the small nations are leading the charge. You look at places like Bermuda, Mauritius, now Vanuatu, they're starting to lead because they're also not bogged down by large legacy systems. It's very hard to change laws, in the US or in Australia. And I think innovation and technology will see a lot of the smaller jurisdictions leapfrog, and that's a really good thing. US federal states so different, and it's going to be problematic, and I think it's going to put the US behind in the innovation that they see in the next 5 years. So another very important thing, as I touched on a bit, but you guys are really going to have to make sure that you're on top of it, is the KYC, the Know Your Customer, the AML requirements, and the anti-terrorism financing rules around cryptography. Now, it's quite funny. As I said, I work for a number of law enforcement as well. I work across security agencies. It's a very big misnomer. Everybody, the FATF have come out with your regulations around cryptocurrency. And this is a fun fact, and I say this to law enforcement all the time. So as far as a Bitcoin, how often do you think a Bitcoin is used in a money laundering or terrorism financing transaction? You guys, I'll say 50%. Anybody think it's 50%?
5%.
20%, 5%?
Less than 5%.
Well, it's less than 0.5%. So less than 0.5% of any Bitcoin has ever been used for a money laundering or terrorism transaction. 0.5%. The way that the world carries on, you'd think it was about 50. And the interesting thing is, if you look at cash is the easiest thing to launder money with. It sits at about 45%. And because Bitcoin and Ethereum are based on immutable, transparent, secure ledgers, we can see every single Bitcoin that has ever been created since the beginning of time. So it's actually the best law enforcement tool we've ever seen. I work with a company called Chain Analysis, which do deep forensics and deep on the blockchain. They're a very good company. They work with most law enforcements. They're working with us in Vanuatu, and we can actually see the movement of every single Bitcoin across the world. So it's actually a very good law enforcement tool. One thing I forgot to tell you. So when Bitcoin was created, Satoshi Nakamoto, happy birthday, Satoshi, he created 21 million Bitcoin. So that's it. So there is only 21 million Bitcoin in existence. And so in the way that it's sort of like gold, it's a finite sum. So people say, that it's intangible. There's only 21 million Bitcoin. And the people that look after the networks, we call them miners. So as a reward to keep the integrity of the network the way that it is, the miners get rewarded in Bitcoin. So we do what they call mine it. So we're up to about, I think 18 million Bitcoin have been mined. So that's why it's also very high in value, because people like to buy stuff that they think scarce. It's that mindset of people. It incentivizes people to keep the network integral by incentivizing them with Bitcoin. Something like Ethereum, another blockchain, doesn't use the mining mechanism. If you're keeping the network good, you get paid a licensing fee. So that's also a bit of a difference on the blockchain. But that's also another very specific characteristic of Bitcoin. There's only 21 million. So as I said, the first movers you've seen have been small island states in regulation of digital assets. They're still arguing in Europe and the US and in Australia. They still can't come up with a definition, and that's going to take a long time, I think. So I think, but if you look at where blockchain is and what people are talking about, the IMF, the World Bank, the OECD, everybody's seen that this technology is not going away and this new asset class is not going away. If people think that Bitcoin is dead, you think again. So as I said, with 110 million users in Nigeria, you've got about 50 million, I think, in India. You think about the emerging world. They will lead the rest of the world in the uptake of social adoption. And that's got a lot to do with mobile devices. But anybody can be an entrepreneur now. Anybody that has access to the internet, anybody that has access to a computer can teach themselves to code. So we're seeing these new business mechanisms, these new opportunities come up every single day. And it's really exciting. So I think where's all this heading? I think the AML CTF requirements are still paramount. You've got to understand, people need to know who their customers are of this stuff. Make sure that you're not in breach of any money laundering regulations. Audit and compliance are now coming up on these protocols and these projects. And I think the last thing I'll say is that it's mainstream. Digital assets are now mainstream. 3 years ago, I wouldn't have said that, but I think sitting here today and seeing exactly what El Salvador did yesterday, the asset class is now mainstream, and we all just need to understand it and work together. Because I always say, if the internet taught us anything, the walled garden approach doesn't work. So regulators, governments, industry, everybody has to work from the same side, because we're all on the same learning curve. Nobody has the answers and nobody understands the technology. So if we work together and we're in a collaborative way, I think, the next decade is going to be really exciting.
Loretta, can I ask one question? I'm sitting behind the screen, so maybe you can't see me.
I can hear you.
You mentioned something about the KYC. You also said something about P2P transaction. So can you explain where the KYC is applied? At what stage?
So if I've got a wallet, has anybody actually got a wallet? Other than everybody, the regulators are ahead of industry. This is hilarious. So what I'd ask you all to do, to be a play around, go home tonight and download something called a Jax wallet. And try and get an account on an exchange. So whether that be a Binance, a Kraken, a Bitstamp, a BitMEX, one of the big exchanges, go in and try and open an account. Because if you're going to be broking this stuff, it's really good if you understand it. So if I've got a wallet, I use Jax. I also use something called the Wallet of Satoshi. And I'm going to run out of all my Bitcoins very soon. But like I did with the commission, if anybody, you can message me on LinkedIn if you want me to send you something on Wallet of Satoshi just to see how easy it is to do a transaction. I can send everyone a fraction of Bitcoin. I'm happy to do that. So when you've got a wallet, so I have a wallet, you give me your wallet address, I send you Bitcoin or Ethereum, whatever, instantaneously. There's no middleman, there's no bank, there's no institution, it's just me to you. It's what we call peer-to-peer. Now that's good. We can do peer-to-peer transactions all day, but at some point, if I'd like to trade another cryptocurrency or I'd like to trade a bigger volume, I'm going to have to do that on an exchange or do it via an OTC desk. So why you have exchange accounts is it's all pre-funded, by the way. So I have exchange accounts in Binance, Kraken. I move money from my bank account into Kraken. It sits in my account on Kraken. Then I decide, Bitcoin's doing whatever now, I'll go and buy some Bitcoin. I do that on the exchange. They match my buyer. They match me to a seller, or if I want to sell it, they match me to a buyer. So that's what an exchange does. Generally, the exchange fees are quite low, and then they will move that into your wallet. They hold custody of my digital asset while I'm doing that. If I've got it on my phone or on my own wallet, that's my responsibility. But I'll talk about custody in a minute. But if I go and if I do it on an exchange, then I realize whatever the value, I decide I want to sell out of it, and they would wire transfer that back into my bank account. So you use an exchange basically to trade. I would hold in a wallet, like a wallet of Satoshi or a Jack's wallet, only as much cash as I would have on my phone. So in your wallet, you probably want to hold, $100, $200. Your exchange, you probably, whatever you trade with, you're happy to hold. When you get a lot of cryptocurrencies, and this is the biggest problem that we're seeing, and it's the one problem that's kept me up at night for about 9 years, it's the custody. Because once you have a wallet, and it's what we call the keys, if you lose, almost like your PIN number, if you lose the PIN number to your bank account, you can go to the bank and get that PIN number back. You can get back into your money. But if you lose access to your wallet with your cryptocurrency, that's gone forever. Many people have lost it. So it's an onerous thing to be able to hold custody of your own cryptocurrency. That's why a lot of people give it to the exchanges. Now, the problem with the exchanges often is that they hold everybody's cryptocurrencies in a centralized database. So you've all probably heard about hacks. There was a hack about 3 weeks ago in a DeFi project where $700 million got taken. And luckily, the guy was what we call an ethical hacker. He gave it all back. Because he just hacked the system because he could. He wanted to prove to everyone that he had the ability to hack. But had he not been an ethical hacker, that would have been the biggest theft in history of cryptocurrency. So the custody of it and how you hold it is very important. If you're going to be transacting on behalf of your clients, you don't want to put it in your wallet. You have to have a third party that understands how to hold custody of this asset, because as I said, it's a decentralized asset. It's very easy to get hacked. It's very easy to lose. Once you lose it, you never get your keys back. So you've got to think about custody really carefully, because it's not like holding money in the bank or gold in a vault. Yeah, it's a digital asset, and the biggest problem we find in the industry is the ability that people either lose or have their digital assets stolen.
I have a question. Thank you for your answer. That was a great presentation. I wanted to ask how the environment and relationship between the businesses, the government, and the banks changed when the regulation was placed in those countries that you worked at. As you said, Bermuda, Malta, and then the second part of the question is, how did the view of Financial Action Task Force and the OECD change towards those countries? So is their view better towards those countries when they have the regulation there, or how is it?
Yeah, so when I first went to Bermuda, so I'll use this example. Bermuda's a country of 60,000 people. 2 of the biggest ICOs in history were done in Bermuda in 2016 without the government or the regulators ever knowing. So that's why regulation was very important to them, because they were in breach of everything without knowing that two companies had come in, set up, done an ICO, raised that millions, like tens of millions of dollars in their jurisdiction, and nobody ever noticed. So that's why regulation was important, because no regulation is bad. Over-regulation is worse. So we set up regulation, and it all comes down to the beneficial owners. And the FATF, so when we talk about money laundering, terrorism financing, the FATF want to understand who the beneficial owners are, always, who owns a company, you know, if there's people or political interest behind it. That's effectively their main goal, is to know and ensure that jurisdictions understand the beneficial owners of companies and money transfer. So that's what the FATF did. So we did that in Bermuda, set it up. As I said, I work very closely with the FATF. I worked with them on lots of policies. I work very closely with the OECD. So I've always done it in a collaborative manner and have involved them. So like in Bermuda, we made sure that we covered off all the AML CTF requirements under the FATF standard and just in general. That we worked as a task force. So there was myself, I took in two cryptographers, a guy called Joseph Weinberg, who owns something called Shift Networks. He's probably one of almost the original Bitcoiners, to be honest. I mean, he's probably two spaces removed from Satoshi. So he came in to a number of countries I've done it with as a cryptographer and as somebody that is in the Bitcoin world, and helped me and the government and the regulators and the FATF figure out how the technology could be used to help in writing. So in all those countries, it was a very collaborative process, is the answer to that, and it works very well. Because, you know, regulators are not technologists, and technologists are not regulators. So you need to bring the two worlds together to write this stuff. So that's why I think it's worked in the places I've gone. And I've always, you know, in looking at what the FATF require, I always bring them on the journey. I always have people that are experts in FATF methodology to ensure that whatever regulation and whatever law we're writing is totally compliant with that guidance.
Okay, but and then after the regulation, let's say, were the local banks kind of more favorable to those people who were dealing in cryptocurrencies, let's say backing them, or not really?
In Bermuda, they have a problem in Bermuda, and it's not so much just on the banks. It's because Bermuda is an overseas territory of the United Kingdom. So every time they have something to do, there's a change in law about money or banking, they have to get the sign off of the Queen. It's very problematic. And banks generally around the world, when in some jurisdictions, it depends on their corresponding banking relationships. I find the US banks are much more sticky. European, Asian banks are much easier to deal with. The US banks have been very sticky, but they've also been very sticky because they've got a big invested interest. The US banks really do see cryptocurrency as disintermediating them. So it all comes down to people's corresponding banking relationships and also the risk of the bank. Every jurisdiction I work in, there are banks that have now come around, because I think the thing is for the banks, the banks thought that cryptocurrency was going to go away. Probably, you know, in 2016, 17 and 18, when you had this huge hype and then you had this fall, I think that people just thought it was a fad. What you're finding now is if you look at the market cap of Bitcoin or cryptocurrencies today, this morning, it sits at 1.59 trillion US dollars. So whether you like it or you don't like it, yeah, banks are in the business of making money. They can cite all the risks in the world around AML, CTF, which is fine. But I don't think it can be seen as a compliance risk with banks anymore. That has to be seen as a business decision. Because if you're opting not to bank a $30 billion company, you're hitting your own line. So I think you're seeing probably now more than ever, the business case for decisions for banks to bank this industry are the highest they've ever been, and more banks globally are banking them.
Loretta, just I personally feel like it's happening. There's almost 2 trillion in the world, and I know these exchange like Coinbase is on the stock market in the US. It seems that it's happening in Hong Kong, in Singapore, all over Europe. Banks in the US are friendly, some of them, Silvergate or others are friendly to that business. So despite the regulation not being maybe there or they are not progressing, they are kind of making it happen or it's happening there. And at the same time, I feel like we feel pressure on maybe like a country like Vanuatu or Mauritius or people that to not touch it, to leave it to them to or something like have that. So, but on the other hand, you are saying that you feel like these small countries are actually leading the way maybe for regulation. So how do you reconcile that? Because it's happening in a way. It's not waiting for us to happen. It's going to happen with or without us in a way.
No, well, I mean, I think there's a much bigger capacity for innovation in smaller countries. I mean, let's face it, you can't go and build a manufacturing unit to build cars in Vanuatu or in Mauritius or in Bermuda. You have to think of ways to improve the economy that involve things like technology are easy because it's not reliant on people, and things like building manufacturing plants are very expensive from infrastructure. So I think that's why you're seeing the lead from a lot of this and the small financial centres that are already quite innovative. I mean, if you look at those places, they've been doing financial services for 20, 30 years. And look, I'll give you an example. So in Bermuda. So Bermuda's 60,000 people. So when I came in and we wrote the first legislation in 2018, the Digital Asset Business Act and the ICO legislation, we were able to facilitate, I think now 280 companies have actually moved to the island because this ecosystem wants to be regulated. You've got to understand, you've got all these entrepreneurs, they're becoming billionaires. I mean, I've seen some of these kids in these projects that I've watched grow since 2014 to now that they didn't have money to buy Coca-Colas in pinball parlors, and I was buying Coca-Colas and pizzas, and now these kids are buying jets and Swiss government bonds, and they're worth billions of dollars. So the ecosystem is full of lots of young entrepreneurs. They don't want to break the law, but they're not in the business of writing regulation and legislation. They're just entrepreneurs that are building businesses. So the industry will go where there's sensible regulation. And as I said, in Bermuda, we attracted 270 companies. I think that has done an economic injection in the vicinity of about $700 million. So you can't tell me that, that once you write regulation that is sensible and sustainable and you attract the good part of the industry, you don't want the nefarious actors, let's be honest. But, most of this industry are not nefarious. And if you can attract them, and they can set up with a proper legal framework that's not going to change on them overnight, and that they feel comfortable that they can build their businesses, they'll go anywhere. This ecosystem is digital. It's global. It doesn't need to, it's not based on being in the US, in Canada. Those days of sitting in a large epicenter like London, New York are gone, and these entrepreneurs don't want to. So on the basis of that, if you look at the experience I had in Bermuda, that's a lot of money to inject into a country of 60,000 people. And you think about how you can then teach kids to code, how you can better everything for, infrastructure projects can be built. The country has money, kids don't have to leave the island because there's nothing for them to do. They can start to learn to code, to be entrepreneurs. All these flow-on effects by having proper regulation and legislation, I think you're seeing now and in the next 5 years will be very important, because you don't need to be big anymore. And I think what you see in the US banks will like to say, that they don't want to bank this ecosystem, but behind the scenes, you're seeing everybody be banked. I mean, Coinbase are banked, Kraken's banked, Binance are banked. The industry is being banked because they're too big not to bank.
And that's it. That probably Europe and US they don't need like sophisticated regulation, but we do need it to make us like attractive for these guys.
You need regulation that's sensible, and as I said, no regulation is really bad. People are going to come in and do things, as I said, like ICOs, if there's no regulation that stops them, and that puts a country in more duress than having regulation. I mean, that's what happened in Bermuda. They were terrified. You know, these guys came in and then they just disappeared. So you need some guidance. You can have regulation which doesn't stifle innovation. It encourages entrepreneurship, but it keeps out the bad guys. So when I say that, you know, having requirements like head offices on island or a number of directors, because when it comes down to what things like AML CTF, what they're looking for is substance and beneficial ownership. So once you can sort that out, and I mean, some of the laws I've written in around the world, people have said are quite harsh. Like I've put in civil penalties and criminal penalties, because you can be sitting in a beautiful island, but if you're on the other side of the jail fence, it's probably not so beautiful. But that stops the bad guys. And it's only a very small percentage, but you need to have penalties that stop bad guys doing bad things, because everybody uses technology for good and bad. Let's face it, you know, the internet is used for a lot of good, but also some bad. So as long as you have rails around how to stop the very bad, you can manage everything else. And you do want to attract, you know, this is an ecosystem that's got so much money, $1.6 trillion. They want to go places where they're welcome, they're comfortable, and the law says what the law says and doesn't change.
Just quickly, am I right thinking that most countries in the world have no legislation on it, but there's really like a limited amount of countries that make it illegal? Actually, most countries, they just don't regulate it, but they're not like officially making it like an offense to deal in digital assets.
So the only country where it's illegal, and they've done this for a very different reason, is China. So in China had most of the miners. In 2017, when these ICOs were happening, a lot of the money was coming out of China. So the Chinese government, we all know, are communist. They don't like the concept of decentralization because they like control. The whole concept of Bitcoin and decentralization and cryptocurrencies is about decentralization, about democratizing things like financial services. So the Chinese do things because they want to control. So they banned ICOs. They've just banned mining of Bitcoin in China, but they're bringing out their own central bank digital currency. Now, that central bank digital currency is in direct competition to cryptocurrencies. And they're doing it because they want to control. So it's not banned per se anywhere else of note. The Indians tried to ban it, but just because they didn't understand it. The central bank governor, a number of them, they just don't understand. But if you look at the amount of social adoption of things like cryptocurrency in India, it's too big for them to ban now. They'll have more than half the country doing illegal activities, which is not good because they're not. So China have banned it, but they've banned it because it goes against the ideology of the party. And I think to them, because they banned mining about 6 months ago, so everyone's moving their mining rigs to mine this Bitcoin. And when the ICO ban happened in 2017, the Chinese government tried to take over the network. And remember I told you Bitcoin's decentralized. We all have to be in agreements, 80% of us, to change the network. So the Chinese banned ICOs because they tried to take over the Bitcoin network. They couldn't do it. So it was the best experiment in human history, because it proved with decentralized databases, it doesn't matter how big you are, how powerful you are, or how much resource you got behind you, you still can't change the protocol. So that was then why you've seen things like Bitcoin have such an uptake, because they're proving to be very democratic and over time.
Alright, we'll have a few more questions here. So
yes, one question, because my background is legal and you touched on AML CTF. Can you talk about the travel rule and this FATF requirement that on transaction there needs to be that additional communication or exchange of information on the parties to the transaction? How does that work on top of a system designed to be secure, anonymous, and so on?
So the travel rule is one of those things that's also kept me up for nights for years. So under the recommendations out of the FATF, that they came up specifically with 4 recommendations that are specifically for virtual assets. Now, as I said, they refer to digital assets, or the part they're looking at virtual assets, i.e. effectively just cryptocurrencies, but cryptocurrencies that operate on a centralized and decentralized database. So both of those databases. So effectively, it's just cryptocurrencies. So recommendation 10, recommendation 15, effectively refer to new technologies. And when you're in the banking system, so if you're moving money from one bank to another bank, or I'm moving money from my account to your account, the bank needs to know that I'm the owner of that account. I'm Loretta Joseph, my address, and they need to know your name, address, and details. So that's what we call, that's the SWIFT movement of money. So that's what the FATF were trying to liken virtual assets to. And the industry were like, well, if people have a wallet, I mean, I can just set up a wallet on my phone. I'm anonymous. Like, I don't need to give in my credit card details, my name, my address. But what they're referring to is the movement on exchanges. So all exchanges now around the world, Binance, Kraken, they have to do a KYC. So if you go and open an account at one of those exchanges, the reputable exchanges, there are some exchanges globally, a lot of them are in Russia, some of them are in Africa, where you don't have to do much KYC. What they're trying to do is get rid of them out of the system. So if you go onto an exchange, you've got to give your name, do all your KYC with them, and have a bank account. So effectively, when I'm moving Bitcoin from, say, Kraken to Binance, the Kraken guys have to prove who is that owns the wallet that's moving it, and to what wallet it's going, who's behind the wallet at Binance. Now, that's actually doable. The industry hit back for a lot of the time, but as I said, Bitcoin is not anonymous. It's what we call pseudo-anonymous. It looks like it's anonymous, but because it's on a immutable, transparent, secure database, I can see every Bitcoin that moves between every wallet address around the world. So once you go onto an exchange and they've got my KYC details, they can prove that it's me sending the Bitcoin to you. And they just have to prove for with the FATF under the guidance, they have to be able to prove that, which they can.
Yeah, go ahead.
Yep. Loretta, acknowledging the benefits of digital currencies, what would be the best way to develop a national currency for Vanuatu, knowing you mentioned the Marshall Islands failure? I'm thinking financial inclusion and ease of doing business between tiny islands where the cost of transaction is very high.
So there's a difference. So we're talking about digital currencies, and when I talked a bit before about central bank digital currencies, they're not the same thing. So a central bank digital currency is effectively the digital currency of that country. So it's digitalizing the fiat currency. It's not anonymous. It's related to a virtual currency. So many countries around the world, and I'm involved in a number of projects, in fact, in Nigeria, one. So yeah, you're very right. A lot of people don't have access to the banking system. So you look at places like islands, Nigeria, West Africa, India. If I don't have a bank account, which most of the people don't, and in the West, people that the financially included, it probably sits at somewhere between 90% and 94% of people having bank accounts. But when you go into the emerging world, 97-98% of the populations don't have bank accounts. So how, in things like the pandemic, how do we move money and get people that really need money or income in things like a pandemic? How do we get to them to that quickly? It's proven very hard around the world. So a lot of countries are looking at developing a digital version of their currency, but putting it on the blockchain system. So it adds security, it's decentralized. So you could then get all your citizens that have a digital ID to have a wallet address, and the central bank can helicopter money into that wallet. I have the one problem I have, and it's good for things like financial inclusion, cost cutting, efficiencies. But the one problem I really have, and I think about this all the time, and I've written lots of papers on it, should we be giving central banks access to people's money? Because central banks, have prudential controls. Money is something that should I be giving all my information to a central bank? Should central banks be getting into the businesses of giving home loans and credit cards and passporting into wallets, direct money into people? I don't know. because I think some of the unintended consequences of doing that, you have the right to keep money under your bed, you have the right to have a bank account, you have the right to have gold, you have the right to do whatever. But once you give all your details to a central bank, they're going to have control over your money. And once the central bank has control over money, they have control over everything you do as a citizen. So I have this problem about the unintended consequences of doing, just because we have the technology and it work. Should we be doing that for society reasons? I still don't know, but should we do I want that to happen to my daughter or her kids? The unintended consequences of using technology to give a state total power. I'm not sure that's the right way to go. If we could do it conditionally, and central banks could, passport money into people's wallets at times, of natural disasters, I think there is a place for that. But I think we have to think through that very, very carefully, because just because we have the technology, should we use it? It's something I'm grappling with. You can all give me comment on that, over time. So I think there's a use for it, yes, for a central bank digital currency. I don't think it's in retail, central bank digital currencies. I think if central banks could be doing it between central banks, so to increase the efficiency and reduce the cost of things like cross-border payments, trade agreements, there's a very big use case. But should we be getting central banks into the business of banking people? I'm not sure.
Why not, Ethan? Sorry, just for a question. Why just not do it the same way as for a tangible cash currency? Like the central bank will provide the tokens and the commercial banks will do the commercial part with the customers.
Yes, so this is one model, and I think this is one that works. The only problem is this is very technically hard to do, and the technologists that build decentralized systems, it's technically hard to do. We're trying to do it in Mauritius at the moment. There's been a couple of pilots work in places like the ECCV, the Eastern Caribbean Central Bank, but the governor there has a very different need. So because a lot of the Caribbean is blacklisted by the FATF, there's no corresponding banks. So Timothy Antoine, he's in control of 8 islands in the Caribbean. He is not going to have one corresponding bank in 3 months. So his need to bank his people came out of the problem with the corresponding banks. Now that's a very specific use case. And should other people be doing that? I don't think so. But I do think where there are commercial banks, and if you can do things what we call on-chain and off-chain, because you don't need to move everything on the blockchain. That's also very inefficient. So if there's ways that you could, the central bank could give the commercial banks money, still be in control of monetary policy, move money from the commercial banks into the people that need it. Yeah, there's a really good model there. But like everything, how do we get that technology that works? Because also what we're seeing in blockchain, you've got Ethereum, you've got Bitcoin. The problem is with this technology is scalability, interoperability. So which blockchains can talk to other blockchains is a big problem. Scalability, you may be able to. So if we look at the SWIFT system, so when we're doing banking transactions through SWIFT, millions of transactions go through a second. With Bitcoin, there's only 10,000 transactions, and it takes 10 minutes for one transaction to be verified. That's very slow and doesn't work in the real world. Same with Ethereum. Ethereum is up to about 3 million transactions per second, but that's nowhere close to the SWIFT system. So we still need the technology to be better at things like scalability, interoperability, before we can go really mainstream. Because what you might, unintended consequences, you can try and build this stuff, but if it all breaks down in a real world, you can ruin lives. So, there has to be a balance, and a mindful balance, when you're looking about rolling out these things as well.
Just on that same, sorry, Loretta. Just on that same topic, the Bahamas and the sand dollars, interesting experiment. What's your views on that?
I know those guys well. Well, there's another problem as well. So they had there's a company that was doing tokens between the banks, which is working, but the actual sand dollar project doesn't work outside the Bahamas. Like, it doesn't connect with any other system. It's also very slow. It's clunky. They had a hack on it last week. So there's problems with all these pilots, and you're always going to get that. You know, when technology is new and there's no, you know, track record, but you don't want to be putting an entire country, you know, on the chopping block to work out whether the technology works or not, because you can ruin the lives of people. And that's what I always say to central banks and governments, you know, be very careful what you wish for. And the same thing happened in the Marshall Islands when they tried to introduce this legal tender in 2018. They had a bunch of Bitcoin technologists that came in and said, oh, you know, we can change everything, we can make it better for the country. They bought into legislation that they were going to have this digital dollar. Of course, the pilot didn't work, the technology didn't work, and they're now stuck with legislation. So you've got to sort of be trepidant on how much the technology can actually, yeah, there's a lot of promises out there. Things, but does it actually work in scale, and does it work, you know, at a level of a country? We just got to be a bit trepidous, because I don't think the technology is there just yet. Yeah, things like cryptocurrencies and speculation and volatility, that's an asset that works. We all know that. But applications outside cryptocurrencies, let's be honest, the only application of blockchain that is 100% working is still Bitcoin. You know, even Ethereum's having its problems. So, and that will get better. You know, in the next 5 years, we'll see huge amounts of innovation, but don't wish for things that we don't see actually happening. A lot of technologists overpromise and underdeliver, and we need a lot of over-delivering and under-promising.
Loretta, just one question on the beneficial owner issue, which is going to be the dominant driving force in AML forever. Now, there are instances where hackers, I mean, for example, I've been receiving a lot of emails claiming I've been recorded doing something, watching whatever, and to pay so much money to this link. Now, can you track down the beneficial owner to that particular link? There's another example in the US, one power company recently got hacked and they had to pay millions of dollars to release. Now, can you track, using that link, track it back to the beneficial owner of that account?
Absolutely. So I mentioned a company I work with, Chain Analysis. That's what we do. We do deep forensics, and anybody, any person that is a fraudster or, you know, is laundering money or a terrorist, and they think that they're smart by using Bitcoin, they're not. I mean, like, there's been some cases recently in the US. So what we do, we can actually track and trace every wallet, and we can watch it, even in wallets in Vanuatu, we can see the move. What happens is, somebody, like one of those guys, will have many wallet addresses. They'll try and obfuscate, you know, the ability for law enforcement to track them. They'll have wallet addresses in different countries. But what they get caught out because at some point they have to move a small percentage of that cryptocurrency onto an exchange, onto a regulated exchange that has KYC. The minute they put, you know, a hundredth of a Bitcoin onto the exchange, because we can get all the exchanges to set up what we call alarms. So yeah, we can track sanctioned wallets, people that are on watch lists, all those things. The exchanges have the capabilities to do that. So the minute one of those guys puts a tiny bit of that cryptocurrency, and don't forget, we can also figure out what the cryptocurrency is because it's all mined. They can track and trace it and nab them. And there's been many, many cases, like especially in the last couple of years with Chain Analysis. There's another one called CipherTrace. So in fact, yeah, the technology around the technology is the best for law enforcement. But my answer to that is absolutely. I'll give you one point.
So not so long ago, there was a case where they tracked, I think, with Chainalysis, money laundering case, which happened 10 years ago. So they were, just back to the source.
So don't forget, with all of this, like every cryptocurrency from what we call the Genesis block, from the first Bitcoin ever created, we can see every single movement because it's on that database. So about last year, there was a united operation amongst a lot of law enforcement, a lot of the security agencies, and they'd been tracking a human trafficking sort of cartel for a number of years. They had found it impossible to arrest and charge anyone. So what these guys started to use was, and they were doing a lot of child pornography, they started to use Bitcoin. So all law enforcement got together with all the exchanges and they started to profile these wallets. They were in one day, they did in the space of 15 minutes, they did a swoop across 700 countries and arrested 1,500 people. They broke the biggest child trafficking ring ever in history. And they did it because they had the ability to use the technology to do it. So that's some of the good side of well, you never hear about. So that was sort of the good sides of how law enforcement were able to stop some really bad things. Because I think that's also the other thing, like nobody wants human trafficking. Nobody wants people to blow each other up, and no one wants money launderers. And the industry doesn't want that, let's be honest. I mean, they're basic human things that none of us want. And the industry are very happy to comply with law enforcement if it means that we all work together to stop that. You're always going to have nefarious actors, but when 99.9% of an industry work with the good guys, we can stop the bad stuff.
I just have a question, sorry, back to basics. In what you say, there are different levels of concept, and I understand some of it, but going back to the basic, there's something I don't understand about the Bitcoin. You said there's 21 million Bitcoins, and you talked about mining and 18 million Bitcoins being rewarded to miners. I'm lost.
Okay. So this is a bit grutty, so hang on there, I'll explain. So when Satoshi created the Bitcoin network, there's 21 million Bitcoin that were created. So it's a digital asset. There's 21 million of them. We can never go above that. So everybody that comes into the Bitcoin network has to make sure that the network is kept. The integrity of the network's kept. As I said, everybody can, if we're all connected with our computers to the network, we can see every transaction. If I send a Bitcoin to the commissioner, all of you see that and they go, did Loretta have that Bitcoin? And she sent it to the commissioner. And you go, yeah, she's got that Bitcoin, she can send it. So it takes 10 minutes. 80% of you have to agree that I've got that Bitcoin to send. So that's also what we call the double spend problem. Bitcoin solved the double spend problem. I can't spend it unless I have it. There are a lot of accounting rules in history allow you to double spend. In the financial system, banks double spend all the time. So that's also another crucial part of the Bitcoin network. So that takes 10 minutes and then you all go, yep, okay, we're ready to set that Bitcoin to the commissioner. Now, everybody looking at that network we call miners. So the term is called miners. So like everything in life, there has to be a social and economic incentive. So to make sure that the miners are maintaining the integrity of the network, they get rewarded in Bitcoin. So every time there's a transaction done, there's a very complicated mathematical and algorithmic process, sort of like solving a puzzle. And once, and the miners are just computers, by the way. So they're like thousands and thousands of computers all over the world. They're trying to solve this puzzle, but they keep the network, the integrity of the network. So once they solve that puzzle, they get rewarded in a Bitcoin. So on the basis of that, we think there's been about 18 million Bitcoin mined over the life of Bitcoin. And the limit's going to be 21 million. But what happens now, because there's more people using the network, more computers, they do what we call, they halve. So the network gets, there's a halving that happens on a certain time of the year, certain days. So that makes Bitcoin more divisible, because at the moment Bitcoin's divisible by a lot. So you can buy, I think, down to 5 decimal points for Bitcoin. So to make sure that we don't hit that 21 million soon, they keep halving it. Does that make sense?
Sorry, no.
I'll send you something. I'll send you a good YouTube by a guy called Andropoulos, who's one of the Bitcoin gurus. He explains mining very, very well. He's on YouTube.
Okay, thanks.
Just I'd like your opinion about USDC, about the US dollar stablecoin that is not controlled by a central bank. It's like a good alternative.
So I've just talked a lot about cryptocurrencies today. There's other things we say stable coins. There's decentralized funds. So stable coins are actually coins that are actually asset backed. So they're apparently backed by US dollar, they're backed by gold. Stable coins are becoming quite the new flavor because unlike Bitcoin, you can't see the Bitcoin, like it's intangible. So stable coins are meant to be backed. The only problem with stable coins is how do you actually know that the stable coin is actually backed by that asset? So there was a big, there was been a few big scandals, something called Tether, which was a big US stable coin. It was meant to be backed by US dollars. We figured out, and there'd been like a huge amount of speculation on it. They figured out about 2 years ago that the amount of US dollars that were meant to be backing it was only half. So that was a huge problem. So I think that's the biggest problem with stable coins. The FATF and everybody's now grappling on how the hell you regulate a stable coin. But I think stable coins, and have you all heard of Facebook's cryptocurrency called Libra? So a couple of years ago, the reason central banks all got excited about this, because they weren't before, was that Facebook came out and said, we're going to create our own cryptocurrency. And effectively, that was a stable coin called Libra. It's now changed its name. So that got all central banks really uppity because they're going, oh God, like for the first time in history, a tech company can challenge a sovereign state. So if someone like the likes of a tech giant like Facebook can issue its own cryptocurrency, they can actually destabilize the world. So there's been a lot of problems. Facebook were very cheeky. I don't think it was much more than a publicity stunt. But when you have like a tech company that's got 5 billion customers, and I could send a message or money on WhatsApp faster than I could say hello, we almost had a big problem with the world. So that was a stable coin. That project might come back again. I think stable coins are going to be in the news for a lot longer. But my question is, how do you prove that the coin is actually backed by the asset?
Oh, sorry. We have a car moving outside. We have one more question.
Yep.
Yeah, I have two questions. My first question is, I would like to know how popular the investments into crypto assets and holding of cryptocurrency assets is. How popular trading among the investors and the venture capitalists? And the answer is yes. Then my second question would be, what impact does it have on the financial reporting standards?
So you broke up a little bit on the first one. Was that how much investment?
Yeah, my first question is how popular the investments into crypto assets and holding of cryptocurrencies is getting amongst the venture capitalists and the corporate giants. And the second question is, if it's getting very popular, then what's the impact on the financial reporting standards? From what I understand is that currently the specific guidelines under the International Financial Reporting Standards, which is IFRS 9, which deals with all the financial instruments, caters for such transactions. But I'm just a bit confused on whether there would be recent developments into these standards, or are the current guidelines effective enough to cater for the cryptocurrency transactions?
So, all right. So the first part of that question, I think what you're saying that. So I've been in this market since 2014. I mean, the volatility swings of things like Bitcoin have been ridiculous. All right, you saw the year before last, it came down to a low of 3,000. Then last year it went up to 60,000. I think what you're saying, like any asset class, this is just a new asset class. I mean, I've traded immature assets, in the 90s. I traded green bonds, and all asset classes that are immature are very volatile. They're very speculative. They have huge swings. But the swings, and it's hard to do sort of, as a trader, I've always done things like technical analysis. It's really hard to do when you've got no data. When you've got an asset that's effectively just a decade old, there's not that much data. So the technicals don't work so well. But I think what you've seen over the last couple of years with regulation and with sort of mainstream adoption, all the institutions that were bagging this cryptocurrencies are now in it. So every hedge fund I know in the world has got a holding. I think Elon Musk probably rightly or wrongly, I don't think he should have been so vocal about something, one of the cryptocurrencies, Dogecoin. So I think when you've got people like him, you've got BlackRock, there's so much institutional investment now. And that's what I've really noticed over the last 5 years. The institutions are getting more and more involved. I mean, a lot of companies I speak to are now looking to hold, 1% on their balance sheets, which wouldn't have happened 3 or 4 years ago. So I think you're seeing the asset class seem to now, it's still relatively immature, but it's starting to move out of that big immaturity stage, and a hell of a lot more institutional money coming in, like we've never seen before. And I think that's good for the market, because it'll start over time to crush the volatility. And the second part of the question was about reporting.
Yes, what impact does it have on the financial reporting standards? Are the current guidelines effective enough to trade about the cryptocurrency transactions, or would you need to have further developments in the international guidelines?
So that's a really good one. So that's the answer to that is it's been very difficult. So as I said, with things like doing like harmonized definitions, I've worked really hard for the last 7 years around the world, even to get something like digital assets being commonplace. Standards and common terms have been very difficult. So things like financial reporting, for accounting standards, even tax, tax rulings globally are so different. They're starting to develop, like organizations. The G20 brought this up, I think, at the last meeting. The OECD are working with a number of the other standards bodies to start to get some standards around financial reporting. Accountancies have started to work, but it's still very immature. Like it's got a long way to go. I mean, even on ISO standards around the technology, they've been meeting for the last 4 years and they can't get beyond the second paragraph. So these things are taking time. They're starting to develop though. And I think if you're starting to read what the big consulting firms and accounting firms are coming out, what you're seeing is that there'll be mandatory auditing. Like even for protocols, there's mandatory tech auditing standards that are actually coming out of the industry through self-regulation, because there's been sort of no guidance on a global scale. But I mean, if you want to look that up, I've got some links to it. But there are some a number of reporting standards that are becoming mainstream, but they've come out of self-regulation that hasn't been sort of produced by a large standard-setting body as yet. But it's evolving. I mean, it's still very new, and that's the problem. You've got to also work out now, you've got to talk to your tax guys, because what do you put it down? Like some countries want it down as capital gain, some can't. It's different depending on what jurisdiction you're dealing with. UAE is very different to the US.
Okay, can I ask the last question? Looks like everybody has asked the questions. With this country in the Central America, is it El Salvador?
El Salvador.
With the legalization of Bitcoin as a legal tender, can you explain how that works in terms of monetary policy with the central bank and
So it's very interesting. A friend of mine is a guy called Brock Pierce. I don't know if any of you ever watched the movie The Mighty Ducks. He was a child star. So Brock and I have been friends for a long time. He actually ran for president of the US last year. He didn't win it, but he's been sort of a Bitcoin crypto maximalist. He's made a lot of money. Like he'd be worth in the vicinity of about 10 billion US. He's a bit of one of the visionaries. Brock went into El Salvador and he actually asked me to help him. And I said no, because the unintended consequences of making things like Bitcoin legal tender are very paramount repercussions. If you're going to make legal tender of something so volatile. So my question is around that. Was it done for a political marketing ploy? Or is it done because they think that Bitcoin's going to help the country? If you're a Bitcoin maximalist and a libertarian, yeah, democratizing money probably works. But if you look at someone like El Salvador is the poorest country in South America. There's no infrastructure. There's no internet connection. So you think about, you're talking about a digital asset that lives on the internet. If you don't have access on your mobile device to the G network of the internet, that's not going to work to start with. So you've got to go back to basics. That's going to be problematic for them. They've bought, apparently in the news, they bought 400 Bitcoin. Guess what that's going to be? that's going to be rife for somebody to come in and try and hack it. And I tell you, all this is an ecosystem of kids that hack stuff. They will put them, their cybersecurity resilience at a maximum, and I don't think the country has the infrastructure to do that. Thirdly, so you're going to make legal tender out of a Bitcoin. So what happens today, we learned yesterday, when the price moves $10,000? Are they going to reval that at the end of the day by the government, or are they going to wait till the end of the week? There's all these questions about how this actually works from a prudential regulatory framework, or actually just on a macroeconomic framework. I don't know, and nobody can answer me these questions. So that scares me, because I think if you're trying to do this for a media stunt, but you're putting the lives of people in front and foremost, it's going to be problematic. So you've got a speculative asset that's now legal tender. So you can walk in the morning and it might cost you $5 less than it's going to cost you in the afternoon. You've got a country that's defaulted on all their loans to this point. The IMF have already questioned them 10 times up into that. The IMF are not happy with this decision. The World Bank have pulled out of their funding, and you've got the poorest population in South America. Does it sound like a good idea to anybody? Yeah. So I think it was a terrible, terrible decision. As I said, unintended consequences of a bunch of technologists that are not policy writers, and policy writers that don't understand technology have somehow merged together to create the new future and Bitcoin as legal tender. And I don't think it's going to end well. Maybe in 50 years. Maybe it will. Maybe this is the world that we all want. But right now, where Bitcoin sits as an immature, volatile, speculative asset, should you be putting it in as legal tender? And what are the monetary policy consequences of this when you're trying to reval something that changes 20% in a day? What happens now? They bought 400 Bitcoin, and I'm assuming they've used all their capital reserves. What happens if Bitcoin, if the Chinese come out with another statement about Bitcoin next month and it comes off 40,000 US? I always think I'm the sensible adult in the room, and I work in this technology. I am the oldest person, by the way, but it's like I've seen markets, financial markets move, and a bunch of 20-something-year-old technologists that have got no understanding of monetary policy, fiscal policy, and prudential regulation are now going in running countries with a commodity. Good luck with that.
Loretta, how quick do you think Vanuatu can actually progress with a proper enabling legislation and do something that would be that will protect Vanuatu, but that will at the same time kind of enable that this to happen?
Well, I think you're already on the path to it, and you're a hell of a lot far ahead than a lot of countries. So I think from the decisions that have been taken, I think you're on the path to doing it. I think it's going to be very quick.
Yeah, I think, Loretta, I just want to point there. In my opening speech, I made the fact that there's, groupings that are kind of promoting things here and there. But we need to realize that this is a policy issue from the government. There's a task force that has been set up, and Martin has been very, and other members have been contributing to this. And there's a big legislation that we want to set in place. But things of which also we prevent this through what's this act? Yes, that's what it is. And now we are moving. It's kind of a piecemeal, but our hope through this task force that eventually we'll get this proper legislation in place. And then all these products that are coming in, we can sandbox them, and if we have come to the goal, this is a non-board story. So I think that overarching picture must be noted from an industry and regulatory. And I guess for me, coming from the central bank, over 20 years of central banking experience, I cannot just move forward with marketing and products. I have to make sure that supervision and all this is going to be in place. So I think it's timely. We need to work together and come up with the best model for this one. Everybody's cooperation is good.
it's a journey. I mean, as I said before, this is a journey, and you know, nobody's got the answers, but it has to be sensible. You need sensible regulation. You don't need to be putting the jurisdiction under duress for doing, you know, radical things that may or may not work. So sensible regulation, but it's collaborative. You know, as I said, you know, industry, government, and regulators all have to work together, because nobody's got the answers. But if it works like that, you know, as the countries I've worked in, it's amazing what you can do. When I was in Bermuda, from the minute I arrived, which was quite funny because I wasn't going to go, the minute I arrived to the minute we put in legislation was 3 months. That country moved faster than a startup. And they've reaped the benefits of that. It's always hard being the first mover, but I think, and I also writing legislation and regulation, like I've learned a lot since then. You know, 2017 seems like a world ago to me. There was things about the technology, and I think, you know, so I think it's a learning curve. It's evolving. This technology changes every day. What you see today is going to be different in 2 years. Things like decentralized finance, which is effectively peer-to-peer financial transactions, people being their own bank, that didn't exist 2 years ago. Where that will be in 5 years, I don't even know. Things like Martin was talking about stable coins, like it's moving so fast. It's so hard to keep up with. And I do this for a living, but you know, it's what the next innovation that comes up. Things like non-fungible tokens. Has anyone talked about NFTs, non-fungible tokens? So that's another, you know, so these things are effectively digitalizing things like artwork. There's all this money. I mean, somebody bought yesterday the guy from Twitter's first ever tweet for some stupid amount of money, like 25 million US. You know, so you can now, you know, they're now digitalizing things like artwork. That has whole repercussions for things like tax implications and regulatory implications. And, you know, that didn't exist 18 months ago, but you're now looking at an industry that has raised, I think, $1.9 billion as of yesterday. So we've got to look at these things. We've got to keep up, but it's hard to, you know. I guess regulators and policymakers are not in the business of being technologists. And you as industry, you have to keep up with the changes, because I don't think any longer you can just say you're going to have a skill set to do one thing. I think technology is causing such disruption. Like accountants, if they don't understand coding, or lawyers, or you as industry understand these new products that are coming up, everyone's going to get left behind. So we all have we all have a responsibility to make sure that we understand the technology. You mightn't, you know, want to be an expert in it, but you have to have a basic understanding of where this technology is actually taking our industry.
Last point, Lord, I've said to the team, we spent three weeks working on this, and basically the guidelines that we could have put out, basically setting the base of where we're studying. And I'm asking the industry, understanding and support some of the things. Maybe you have some bigger plans, you want to drive this one, but today has given us, all of us, a broad understanding of everything. And I think the important thing is we agree to work along these guidelines and slowly develop things as we go. If anything, Loretta and others can help us with this as well. So, but at least we will be coming up with several guidelines that help set the roadmap for all of us.
Thank you.
Thank you for all listening to me. I know there was a lot to take.
Bye-bye, Loretta. Lunchtime now.
Bye.
Thank you.
Bye.